Hey everybody, and welcome to CED's Raising Money webinar. Today we're going to talk a little bit about 2019 in our Innovators Report we just released. And then we're going to move on and talk to two entrepreneurs who have recently raised some funding about their stories and how they've pivoted and worked through the COVID-19 pandemic. And then thanks to you all, submitted a lot of questions beforehand. We will try to answer as many of those as possible at the end today. So with that, we're going to get started. I'd like to kind of go around the horn and at least give everyone a chance to introduce themselves. I'll start with Thad from Second Nature.
Hello. Yeah, I'm Thad Tarkington, co-founder, CEO of Second Nature. And quick background on Second Nature, we're a subscription service for homes. Started out with air filters, and now we're expanding to other areas of the home, just focused on helping people keep up with home maintenance and convenience. So,
awesome. Thanks, Thad. Next, we got Tom with PatientPay.
Hey guys, Tom Furr here. I'm not sponsored by Nike like that is, but PatientPay helps medical groups, hospitals capture the patient payment portion of the bill. We've got some technology that helps them move away from paper statements and get more into the electronic world that we all live in outside of healthcare.
Awesome. And next, Jay Bigelow, whose name precedes him.
I don't know if I can live up to that. Jay Bigelow with CED, VP of Entrepreneurship. Most of the time I spend working with entrepreneurs on strategy around growing their business or meeting good connections or meeting investors.
Thanks, Jay. And finally, I'm Hunter Young, also with CED. I'm our Director of Capital, help entrepreneurs meet investors and hopefully get funded down the line. So with that, we're going to start talking about 2019. We're not going to belabor this, but obviously 2019 was a wildly different time than 2020 in a lot of ways. But I still think it's a good idea for us to kind of recap and talk about what happened in the past and maybe how that's going to influence what happens for the remainder of this year. So with that, we'll start from the top. I'll pose this to Jay and to the rest of the crowd. Where does 2019 stack up compared to recent years in terms of total funding, number of deals?
Yeah, I mean, overall for the state of North Carolina, it was a great year, 1.5 billion invested. So that's a pretty high number. If that's the trend that we're heading in, it was 5-6 years ago, we were at $500 million. That's an overall nice looking trend at the top line numbers for 2019. As you said, 2020 is going to look different, and we don't know yet exactly what that's going to look like.
Mm-hmm. And, just one more, I would say, on 2019. If you compare it to the year prior, 2018, that was a little bit skewed by the largest deal in the history of the state. Epic Games $1.25 billion fundraise. So, I think if you were to remove that from 2018, 2019 was right on par and kind of chugging along and showing good trends for North Carolina.
Yeah. Hey, Hunter, just add to that Epic thing. That Epic deal last 2018 was the single largest VC deal in the United States. So yeah, it was an outlier.
Pretty big.
Pretty big.
Pretty big one. So, we got this slide up on the screen right now, and you can kind of see how it broke out from a sector perspective. And it looks like relatively even between tech and life science, about 700 million each. I know in the past, one or the other is kind of been bigger depending on the year. Jay, what do you make of that?
Yeah, it is true that we used to think of them from a data standpoint being counter-cyclical. That obviously wasn't the case in 2019. I think as a general trend, it points to the diversity of our tech, both biotech and tech ecosystems, and that we have two strong players in the state, not just concentrated in tech or concentrated in life science. Mm-hmm. I'm not sure in absolute dollars it matters all that much. In markets our size, big deals still count. In life science last year, AskBio had a big deal, and that certainly helped raise the life science dollars quite a bit.
So you think it probably points to a little bit of the maturity of the ecosystem?
I'd like to think so. I talk a lot with some of our Southeast counterparts, particularly in Atlanta. And I think, one of the things that other people see in this space is a more balanced ecosystem. I think if you're looking at some of the economic recovery trends, one of the things they point to is that we don't have concentration. That might not always be a good thing, but in an economic standpoint, from a macro level, multiple markets is a plus for the region.
So maybe not on quite as great a note, but what do you think about the trends we're seeing in terms of number of early stage deals, which we'll call maybe sub $5 million deals? And then after that, talk about the concentration on really, really big deals, call it 50 million plus.
Yeah, the worrying trend that I see, and it's been going on the last couple of years, both here locally but also nationally, is less and less early stage deals. You really, again, want to think about these as cohorts. So you sort of want to see your 2016 cohorts raise again in 2018 and again in 2020, sort of a 12 to 18 month sort of cycle. And we're seeing the last couple of years a decrease in those early seed, pre-seed level funding, which means 3 or 4 years from now, we won't have as many companies getting to scale. So that is definitely a concern.
And what about the kind of the explosion in the larger deals? I think we had 8 50 plus in 19 and 11 in 2018.
Yeah, there's, I'm an old dude, so I remember the various cycles of the VC landscape. There is more money in VC in the last couple of years than there ever has been, probably. So there are an awful lot of funds looking for companies, and any company that's just sort of escaped gravity and is showing good momentum is attractive for venture funding. And so there are more people looking to put money to work in scaling companies. I think we have 2 of them on the call today, and we'll hear more about it.
Yep. So, one trend that we sort of looked at when we looked at 2019, and I'll just say it bluntly, are we a fintech hub in North Carolina? Any other industries where we punch above our weight class? And I think to give a little bit of background on the fintech thing, we had Spreedly raised over 50 million here in the Triangle. We had Encino, which recently made some big news down in Wilmington, and then Avid Exchange just continuously raises 9-figure deals. So where are we, Jay? Are we a hub there in fintech, and any others? Ag tech? Give me something else.
Well, fintech, I may defer to Tom to talk about that, as I really think PatientPay is a fintech company. But we definitely have the ingredients to be fintech. It is, as you pointed out, somewhat spread around the state, so it's not concentrated necessarily. Certainly, Dan Roselli and the folks in Charlotte are doing a good job. Encino, Live Oak Bank, their Canopy Fund is going to make Wilmington a hub, and then there's stuff in the Triangle. So, the state as a whole can sort of, I think, claim to a fintech. I'm not sure geographically we've concentrated that. Other areas that we definitely see, lots of good growth in ag tech. This is on an international scale. RTP in particular is known as an ag tech hub. That started many years ago with the large companies, the Bayers and BASFs and Novozymes and stuff basing their R&D thing. But we're seeing a lot of earlier stage companies now choose to be here. That's a big opportunity for the state. Somewhat surprising to me, and I'm not sure we can claim as a hub, is we have about 110 e-commerce companies in our data set. That's both on the B2B and the B2C side. So certainly seeing, a plethora of e-commerce companies, and in large part, maybe Thad will talk about this a little bit. COVID has changed the dynamics for e-commerce companies quite a bit. So I think we'll see some that have just skyrocketed because of COVID, and that maybe will create more scaling e-commerce companies in the region. And scaling is what sort of helps propel the region to become a hub, as you start to get known for something.
Yep. And I'll ask Tom and Thad real quick their thoughts on what Jay just said. Tom, what do you think about the state and maybe even the Triangle in terms of being a fintech great place to set up shop?
It is. In fact, fintech's a growing space. Now, we're not like Atlanta, who has a lot of fintech because all the processors were started down there, First Data and all that. But we're clearly moving in that direction, and you see it with some of the companies you mentioned. But I also think healthcare IT is a big opportunity for us. You see the various companies that have played in that space. That every day I was just you introduced me to another company that I had no idea was here, but they're in that healthcare IT space, clinical, both clinically and on the fintech side. So I might be biased, but I do think that we have some nice companies out there that are either in the growth stage or been sold, like MedFusion, that clearly, there's an opportunity for us to take advantage of that. And it's a growing market.
Yep. Awesome. Thanks, Tom. And Thad, what about e-commerce? How's the market here changed since when you guys got started to now? Is it growing? Where are we?
Yeah, so in terms of the overall market, I wouldn't say I had the best kind of view of that when we started. But I would say getting networking more and getting to know more folks in the space, I would say there's definitely a growing segment. There's quite a few folks I know that have built e-commerce businesses successfully, either exited them or kind of brought in management to run them, and are onto their second or third. And so we're definitely seeing that kind of growing. And when we look at hiring, in terms of hiring folks for marketing roles, kind of creative, customer acquisition, et cetera, both kind of the e-commerce companies, we're seeing more and more of that. Both traditional retail and other companies here that have gone online, we're seeing that help as well, just bringing talent to the area. Plus a lot of these agencies that are starting to scale up as well. So overall, it's definitely growing. But I don't have too much context on data point in 2012 versus now. So
Awesome. Thanks, guys, and we appreciate those anecdotes. Jay, we touched on it a little bit as it pertains to fintech, but I think every year, if you look at the state, certainly the majority of the fundraising is in the Triangle, and there's probably a lot of reasons why that is. The universities and just sort of the momentum there. Call it 2/3 to 3/4 is generally here. But, can you talk a little bit about, what's exciting outside of Raleigh and Durham and Charlotte? We talked about Encino and Wilmington, maybe Asheville.
Yeah, I mean, there's definitely, there's organizations like NC Idea that are really supporting entrepreneurship across the state. And so there are growing nascent hubs in lots of other places around the state. We tend to focus on fundraising, and that's sort of the purpose of this call. The vast majority of the money is still going to companies that are based in the Triangle or those big companies in Wilmington or Charlotte. But earlier stage companies are growing in Asheville and Greensboro. The Triad area has a good ecosystem being built there. Even some of the outlier places like Lumberton or Elizabeth City are trying to build their entrepreneurial ecosystem. They may not raise the big funds, but in general, economic development and recovery are going to be driven by entrepreneurs. So there's a lot of energy and effort in all markets to grow their entrepreneurial base.
Do you think social distancing and work from home and things like that have been brought on by this pandemic will make it more interesting, not only to move to North Carolina from places like New York and California, which we saw already, but maybe move outside of the bigger hubs even within the state?
Yeah, I'm not, this area, the Triangle in particular, is still a net inflow from folks from other places. I would say once a week I get a conversation with somebody that's moved from California. This week I've had a conversation with a person that moved down from New York. It tends to be, if they want to be in a tech or a biotech hub and they want to have a family, we tend to get on the list. And that's sort of the bullseye, I think, for the region, is the thing that we all probably live here for: decent quality of life, good economic development opportunities, decent weather, not too hard to get anywhere you need to get to, lots of outdoor activities. So that combination of things is attractive to a certain strata of entrepreneurs. And that's historically what we've been, and we continue to be that. So people will look at generally Denver, Austin, Raleigh, Atlanta, somewhat in the same sort of list and make a choice between some of those markets.
Yep. You can either live at the beach, you can live in the mountains, or you can live in between and close to both. And,
Yeah.
Everyone talks about it and it's real. So finally, we'll try to wrap up 2019 here because obviously, like we said, not quite as relevant anymore, but we'll talk about exits. And as we tracked them, I think we saw a decrease in number of exits from 2018 to 2019 to really only about 20 or so in the space we cover, one of them being an IPO. Anything to read into that?
Yeah, I mean, again, from what I read in the trades and in some of the good sources is there's a large number of large companies looking for acquisition for innovative companies. And so I think the M&A side, you should continue to see that uptake. Now, again, COVID has put a pause on a lot of things. So there may be a slower uptake than we've seen in past years, but large companies know that to innovate, you're probably going to acquire some younger company. That has always been the case in the biotech, but I think we're seeing that in corporate America as well, outside of biotech. So M&A should be the uptake for us. IPOs are cool. IPOs are sexy. IPOs, certainly put you on the map. So Encino going public in whatever period will be great. Great for Wilmington and great for the state.
Thanks, Jay. And I'll ask our entrepreneurs, without giving away too much of their strategic direction, just over the course of operating their businesses, have they sensed any changes in how they think about potentially exiting their business? Are they more inclined now to just want to run it indefinitely, or has that changed for either of you?
Ed, you want to go first? You want me to?
Take it away.
So, Hunter, it's a great question, and obviously you build a business to be acquired instead of build it to be sold, hopefully. But to Jay's point, in fact, I was just watching CNBC talking about this. The days of buying your stock to pump it up are slowly dying down, and potentially going to be gone. And so you've got to create value as a public company beyond financial engineering. And I believe that there are going to be a lot more big companies that have to buy creative, innovative type small companies, because no company beyond Apple is able to build technology successfully. And there's also a shift in particular that touches both, me and Thad, that people are getting away from the old way of doing things with COVID-19. So in our business, the old way was you send paper statements indefinitely and try and collect. The new way is doing it electronically because you want to, one, communicate with people the way they're doing it outside of healthcare. Two, you want to get away from collecting payments when you go into a doctor's office because you have the potential to spread from your phone, from your card, from whatever, the COVID-19. So there's a lot of things that are happening, and if anything, accelerating some of the good things that companies like, we do out there to make things more efficient. So I think that there's going to be a huge M&A swell, because the other thing that's happened is the feds have taken so much liquidity out of the market that you got to put your money somewhere, right? There's trillions of dollars sitting out in people's banks. And so, you're going to see high net worth people wanting to invest in these, hopefully, early stage companies. You're going to see companies that have to put their money to work because they're not a bank. So it's going to be an interesting, I think, 24 months once we get a vaccine and we realize that the end of the world is not upon us. It's just a new way of doing it. So it's going to be an exciting time for us, and I'm sure for lots of others.
Cool.
Thad?
Thanks, Tom. Dad, any thoughts?
Yeah, and the question was just how we think about running the business, selling, and kind of goals.
Yeah,
So-
just, in your mind, maybe you started your business and you're like, we're going to sell it in 5 years. And now
Yeah.
maybe people don't think like that anymore. And that's
Yep.
why you don't see as many exits. I don't know.
Yeah. So, I could say when my co-founder, Kevin, and I started the business, we were 19 and 20. And so, I'm not sure we really had too much of a plan other than we thought it was a good idea. And, we thought we could build the business and wanted to grow it to some level. I know we've definitely grown past a lot of the initial kind of goals we set. And so I would say our current state is we want to build a massive company. There's definitely different parts of the entrepreneurial journey that, are funner than others, and, things have changed. So, the work we do today is wildly different than, back in 2013 in terms of, how we contribute our time. But, for us, there is really, no specific end state. I think Tom said it well in that, our focus is let's build a great business. There'll be plenty of opportunities. Naturally we have employees, we have investors, and many other folks kind of tied to our financial success. And so, we'll always look at different opportunities, and there'll be different ways for them to recoup their investment. But, we're kind of heads down saying, let's just keep building a good company. And, whether that means there's an M&A opportunity, an IPO, whatever it may be down the road, that'll come when it's time. But, as far as our head's at, we want to build largest company North Carolina. So
Awesome. Sounds like the right mentality to have. All right. Well, real quick before we hear more in depth from Tom and Thad, we are going to have a little audience engagement here, and we are going to shoot a poll out to all of you to see what you think about a couple questions. So be real quick, and then at the end of this, we'll give you the results. So do that real fast for everybody. And then I'm going to turn it over to Tom Furr with PatientPay to talk for about 10 minutes or so about his recent fundraise and how COVID has affected his business. Take it away, Tom.
All right, put me on the timer because I have a tendency to talk a lot. So no, but we are in a heavily regulated industry. We've got two rails that we kind of bounce up against, and we, as I mentioned, work with hospitals and medical groups where we've got to deal with what's referred to as HIPAA. So the privacy that you have to do when you access someone's healthcare information. And then you got to deal with the credit card. It's called PCI. So that when you have someone's credit card, you can't get it hacked and all this other stuff. So we have been a business that healthcare doesn't move real fast. And we've been on that journey now since about 2011, 2012. And we've tried to build it, slowly and from the ground up. And it has been an interesting journey when it comes to financing. So we started out initially raising money from high net worth folks. And we found people that understood the industry. They had a lot of money. They had friends. So it's kind of like, okay, I like it. I'll throw in 6 figures and I can call 10 other buddies.
Did we lose them?
I would highly recommend it. I mean, assuming that these investors can add value, it's a good way to get started, and even better than angel groups, because angel groups seem to have a tendency to go slow and act more like a VC than these high net worth folks are like, yeah, I like it. I'll write the check now. We can move on. So add value. But then we went from there to the VC funding space, and we've raised about $25 million. And I'm kind of embarrassed when I say that, because it seems like a lot of money to raise to start a company. But our competitors, in fact, just announced that they've raised $105 million on top of the 50 that they had already raised up to this point. So I keep referring back to them to say how little. But when we move to the VC world, what is most important is to make sure you find a partner, because you're going to run into good times and you're going to run into bad times. And some big VCs are like, okay, we're going to have 2 successes that are absolute, Facebook type successes. We're going to have 5 or 6 that just kind of bounce along and we get rid of them. We're going to have 3 or so, 2 to 3 that we're just going to write off and walk away from it. And we were very fortunate to find a group of people that invested in us from this VC fund that had operation experience. So they'd been operators, not, no disrespect to MBAs, but, being an operator is a lot different than writing a business plan and doing models, spreadsheets. You need all that, but you realize the stories you read about Facebook are few and far between, because there are thousands and thousands of entrepreneurs that create business that are really good businesses, but it's just not the overnight billion-dollar company. So we were very fortunate, and healthcare being slow, they having experience in earlier stage companies, they've been with us through the good and bad. And there's a lot of bad out there that, no one writes about. But and then we ended up hooking up with a family office as kind of our last rounds. And getting back to my point earlier, there's so much money sitting on the sidelines that it's amazing at the amount of dollars that want to be put to work. And so when you find these family offices, and some are very structured, so they've got, a CIO and all this stuff, and they're sitting on hundreds of millions of dollars that they want to put to work. And some are a little less structured, but still lots of money. And it was a great partnership for us because they knew the healthcare space. They owned a hospital. They owned all kinds of stuff, telco companies, you name it. And to bring them in was great because they had really deep pockets and were long-term investors. But we had this tension between our VCs, who have a 10-year fund, and they want to get out at a certain point. And then you got the family office that says, well, why do we need to get out? If you're growing and you're making making money, let's grow this thing. And when somebody comes to buy it, they buy it. If it's 10 years, who cares? If I take my money from you and put it with an investment advisor, I'm going to get 4 to 5, 6%. So it's been an interesting journey from a financing perspective, but it is so imperative to find partners. And when we got our first VC, the first thing I said to him was, look, when it's easy, it's great. Find me some of your CEOs that, if you will, you're on a cliff and you're trying to decide, are we going to push them over? Are we going to bring them back, keep them going? And it was a good experience and now it's easier said than done in hindsight. So when you're sitting there and you want money and you're trying to grow the business, you're like, I need money, so give me money. But to have smart money that is patient in our world is extremely important and worth the wait. Because if you get someone that doesn't have that approach, one, they're going to just call you. And this CEO that I spoke to said, my prior investors were traditional VCs. They'd come in every quarter. How did you do? Why are you not doing this? Beat them up. We need to sell it. And then leave, say, oh, I'll help you with this. He said he wouldn't hear him again until the next board meeting, and it'd be the same kind of, and he said it was miserable as an entrepreneur. You're just there to grow a business. So it's a very important thing when you go to raise money, either from high net worth folks, or you raise it from a VC, or you raise it from family offices, to really talk to their companies that they've invested in and find out the bad ones. When it was really bad, tell me what's going on, and hear from the CEOs. And it was eye-opening, and they have done exactly as the CEO had said they would do, of their other company. And it's good because, again, you need a partner, and more so than an investor that is off of Wall Street, that's just looking at the quick, IRR, and we got to get out of here in 3 years. And that's, you're here to grow a business at the end of the day, and you need that help. So was that 10 minutes or too long?
You know what? I didn't even start that timer. I do want to ask you, and maybe this isn't even any no aha or nothing too interesting, but I know you did announce your most recent fundraise, I believe, end of March. Is that right?
Yeah.
Was that impacted at all by COVID, or were you guys already pretty much done and it was just signing papers by the time you were able to announce?
I'd like to say I'm the smartest guy on this call, and I saw COVID coming, and so we went and raised money. And now it was pure luck, all right? And entrepreneurship's a lot of luck. we were getting ready to do a round of financing, and we saw some big opportunities that were coming down the pipe. So at our board meeting, the conversation was, do we do something short term and then roll it into a long-term opportunity, or do we just go hard to get the long-term stuff now? And we felt an extra year would give us the time to accomplish some of the things that we felt we could accomplish. And so my existing investors stepped up for a convertible note, knowing that we would raise a much bigger round, later this year, early next year. Now, COVID has pushed things back by about 3 months. So it's probably going to be early next year when we do a bigger round. But there's a lot of money out there. So that, you get into this world of, and I'm sure Thad had as well, but do we go VC route or do we do the PE route? Because a lot of private equity guys are moving downstream dramatically because those perfect 20 million in revenue, 2 million in EBITDA are extremely competitive, right? Because everyone's trying to get those. So we're in a position of talking to both to say, okay, when we get there, and we're talking to them now, we will then be able to know, okay, let's call this one, because really it's better to go with these guys versus this route. And it's really about the dollars you take. They all want you to take more money, because they got so much money and they're not a bank, and their LPs are kind of saying, what are you doing? Let's put our money to work. So we were very lucky. I'm very fortunate to have good investors that, saw the short-term opportunity to take advantage long-term wise from a different type investment, the steps that you take along the way.
Awesome.
So yeah, I'm the smartest guy here.
Thanks, Tom. I mean, I think, it's maybe a forgotten about thing, but luck does play a part, and luck, in a variety of ways. And you could be the smartest guy in the room, but somebody else is luckier. You hate to take it out of someone's hands, but sometimes that happens, and you got to strike while you can. So great to hear. Thanks, Tom. We're going to move on to Thad and hear his story. He's got an interesting one. So take it away, Thad.
Yeah, so to give a little more background on our business, I'll start with kind of the high level. As mentioned, Second Nature is a service focused on helping people take care of their home. We started the company back in 2012. Total to date, we've raised just over 40 million with both equity and debt involved in that. We're based here in Raleigh, North Carolina, and about 150 folks on the team. So kind of quick history of the business, and I'll mix in some of the kind of financing just to give you a picture, and then I can share some commentary kind of on our experience. But, originally the idea was pretty simple. Air filters, there's a couple benefits of changing them, improved air quality in your home, better energy efficiency, and, about half of energy use for a, residential commercial property typically goes to your heating and cooling. So it's the largest item on the list. And the EPA, their estimates at the time when we were looking at the data, it was about 5 to 15% reduction. And then the last one is just the maintenance cost. So again, some research we did, people were saying, top 1 or 2 maintenance expenses, your HVAC always falls in there. And so we kind of looked at it and said, there's a lot of compelling reasons to do this. It's not the most expensive product. Why are people not changing them? And it was simple. They're out of sight or out of mind. It's not something you think about often. And then in terms of market size, we're like, well, quick search, you can tell almost every property today has, some sort of heating or cooling, and they all have a filter. So we looked at that and said, if we can, in one experience, help people pick out the exact size, quality, frequency that's right for their climate and their home, this is something potentially, the right customer could use for 20, 30 years, really the lifetime of their home. And so that was the idea when we got into it. Very simple business. Launched in mid-2013. The quick back on the financing, my co-founder and I started, we both put in about $4,000 for about 8,000 total. Fast forward another, 60, 90 days, we ended up going down to an accelerator, and through that accelerator, we received about $20,000. Used that capital and, ended up doing some friends and family financing as well to build out the original website, get some of the ops in place and launched. And then we ended up doing our first financing after that was about 310,000. That one was through a bunch of local angels. Really on that one, some of you may know David Gardner. We ran into him. This was back before his fund, but the same principle was, I'm going to invest and really roll up my sleeves and get involved. So with RTP Capital, he kind of brought us in there. We raised most of it through RTP Capital and some other angels that we got to know. And that one was about 310K. And actually, funny enough, it was structured, looking back, it was structured where half of it came immediately, and we actually had some contractual milestones on revenue and a few other things to unlock the other half. So that was interesting. But so we did that, kind of got to the next milestone, and as we grew the business and kept wanting to deploy more capital to kind of grow, we ended up doing, another $1 million financing, the next year. And that's where we started pulling some folks like Idea Fund, some other local folks, and then some funds around the country down kind of the Southeast and on the West Coast. And then ended up, as you go throughout the years, we expanded into B2B. So we now do everything from, your residential household to commercial buildings, apartment complexes, things from, 100-story building in Chicago to kind of New York to a, restaurant chain, hotel, stuff like that. So really any sort of property. And, fast forward to 2020, we just did our most recent financing for a little over 16 million bucks. And so that's kind of the history of the funding. So definitely, start out and, I think Jay kind of mentioned earlier, we actually felt right on that cadence of about every 12 to 18 months. I did a financing going from, a couple $100K, $1 million, 4 million, 6 million, et cetera. So that's quick background on the business and our financing history. In terms of, our experience, I'd say one thing that's been great for us, and I'm just going to call this one lucky. We don't have one investor, and we have over, 100 folks if you count all the individuals. And fortunately, we haven't had one bad apple. We also haven't had any really tough necessarily decisions to make that would put pressure on certain folks. So maybe they'll come out of the bunch if that occurs. But, we've definitely been fortunate. And I also look back to, with David early on, we didn't really know what we were doing. We were first-time entrepreneurs. We actually were sophomore, junior at NC State, ended up leaving NC State to work on this full-time. And so, really that first kind of 90 days, there was also two other folks, Tom Latriciano and Joe Schmidt, were some local e-com entrepreneurs who invested early on. And between the three of them, they really kind of taught us all the basics from customer acquisition and kind of the e-com expertise coming from Tom and Joe, and then just a lot of the business kind of principles, things like hiring, managing, et cetera, from Dave. And so that mentorship was incredible. Kind of, looking back, obviously, if we were to start a company again, I think we could have shortened that first couple of years, maybe not eliminated it, but a lot more efficient. And so, they're very helpful. And then, I think about, some of the other funds that have come in with Idea and kind of Lister and John there and, some of these other funds, they've been incredibly helpful. Our investors to this day, some I get on a call with bi-weekly and, they've it's not been the experience, that we've all heard about and Tom mentioned of like, hey, what's your numbers by? How can I help grow the business? They understand the business, really diving in and giving good advice because they get kind of the inner working. And so I'd say, we're fortunate that we've had a good experience there in who we brought on. I'd say one, thing that's changed, I think early on, we were definitely in that like, hey, we need cash to grow this. And I think we got a little lucky. Now kind of in the position we're in and having got a better understanding of the landscape and some of the, stories I've heard out there, definitely making sure it's a good fit. That the investor's good quality, doing your diligence is helpful, but also, what's their personality like? Are you guys going to work well together? Getting an understanding of what's their vision for, their funds and how they're going to be returned. And, there's multiple ways, obviously, for them to get a return on that doesn't necessarily mean you're getting fully acquired and out of the business. But, do you think those options will be on the table? Is there alignment there? And then most specifically, I think on the kind of company strategy, kind of vision of where do you go products, where do you expand, things like that, just making sure there's alignment there can be incredibly helpful. So, but yeah, if I were to kind of sum up our experience, it's been really good in terms of mentorship, et cetera. And then, if you want, Hunter, do you want me to give some commentary on just our experience with the last, financing, or kind of what that process looks like?
Yeah, I know. And I think you had mentioned to me before that I think you also fell into the boat of being able to announce in March, but have it mostly locked up before that. I think, also would be interesting from an operations perspective on how COVID has, changed your business or pivoted your business in the last, call it 30, 60, 90 days.
Perfect. So I'll hit a couple things. I'll roll through financing kind of in some of the timelines, and then I can jump into some commentary on that. So in terms of financing, just, if you look at the history, with the accelerator, that was I think a shorter process, call it maybe a month or two, kind of going through getting into that. We ended up launching in the midsummer and started doing a financing kind of Q3. That original angel round of $300K took a couple months to get together. But, again, we were fortunate that David came in and kind of really was going to do a larger portion of that, very early on, and kind of helped us put that together. As I think about the next financing we did, we actually weren't raising capital, but an investor was interested in putting some dollars to work. And once we decided, it would make sense for us, we ended up bringing on a little more capital around that. So tough to put a timetable on that one. But then if you look at kind of all the rounds we've done since, they were more so planned in that it was, here's our plan we're operating to, here's how much capital and where we could use it. And then we effectively ran a process. That process, generally how we've mapped them out, and I'll give you the specifics where we landed on them, was, let's plan for around 6 months kind of minimum, could take longer to get it done. Our first, what I would, I guess, call our kind of Series A financing, that one we really, the term sheet and that process was fairly quick. A lot of it was either some prior relationships we already knew folks. So it's tough to say like we met someone and, a couple months later it was done. But in that scenario, we had the term sheet and kind of most of the investors rounded up pretty quick. One thing we did experience there is one of the main investors in that financing, who's been really great to work with, post-financing, not that they weren't during, but, it ended up, I think, from term sheet to closing, I'd have to go back and check some exact dates, but it was several months, which typically doesn't take that long. And it just with everything going on and some response rates and things like that, it took a little longer. So that one was surprising that it was a quick process to get terms in place, get people committed, but a pretty long process to close. And then our Series B financing, that one, we actually was pretty efficient. I think it was about a month and a half to get terms, and then maybe another 45 days to close. And so that one went way quicker than expected. And then if you look at our most recent financing, we kicked that off really in beginning of Q2. And it took, about 3 quarters to get that one finalized. And that, we definitely had some different options we were looking at. But ultimately, we were just trying to decide what's the best fit in terms of people, how we want to do this, to structure the deal. But once we got to, finalizing how we wanted to put it together, that one was pretty efficient. And so, one comment I'll make about the whole COVID thing, I think with Tom, was definitely lucky that we kind of had all that legwork done and effectively the deal wrapped, but before things started to really get crazy in terms of the financing market. But, one comment I can go back to, and heard this 4 or 5 years, and every deal we've done, every time we've looked at how much capital we want to take, and the timing of it, there's always been this constant, obviously you don't want to take too much or get yourself in a bad position. But this comment of, hey, you never know what's going to happen. And so let's make sure we're in a position where we've always got enough kind of runway that if something crazy does happen, we have time to respond and do it in a good manner. And so, I think it's funny, and, if in the back of my head, I'm always thinking, well, it's going to happen. Like, and I, as young as I am, I haven't lived through, 99 or, well, I was alive, but not, operating in business. And so, I think it's interesting that, no one thought this was coming, obviously. And the second, everything started to unfold and we just closed it, I thought back to, how multiple people, our board members, as I would talk to them, that just was a constant theme. Like, hey, you never know what's going to happen. So, let's just make sure we're in a good position and we're not stretching ourselves too thin in terms of playing that game of like, how to get the exact amount, kind of time it perfectly where you're maximizing valuation. And so, definitely, was fortunate there, but I would say it wasn't I think people were giving good feedback and we were prepared for that. So in terms of, sorry.
No, keep going.
Oh yeah, if you have a question, feel free. I can shut up. But
hey Thad, how about we'll circle back on the operation stuff on COVID with the Q&A. I know we got a couple. We got to start this Q&A session here, and we got a couple videos we want to roll. So actually, before we start those videos, there were, thank you to everybody for submitting a bunch of questions. We received a lot. If we aren't able to get through them now, hopefully we can get back to you personally via email. So we will pay attention to those questions. The first one actually is a little bit more personal, directed at Jay. It's from a couple people out there wondering if you'll ever get a haircut or if you will ever improve your golf game. I'm wondering if both are just not salvageable. Jay.
In terms of a haircut, I just had one last week, so this is a haircut. I don't know.
Okay.
In terms of the golf game, it's probably hopeless. Despite trying to get better, it's just, I'm not ready to join the senior tour yet. That's for
sure. Okay. Thank you. So with that, back to the questions. Thank you, Jay. I think Jay and I certainly don't know everything. I think there'd be a lot of people who said we know very little. So I think we wanted to outsource to some real experts some of the questions you all asked. So we have a couple video clips. Bear with us as we try to incorporate technology into this webinar. But our first question was asking about recently, was there a specific area in life sciences that was hot last year in 2019? And we asked Ben Scruggs from Hatteras to give us his answer.
Thanks, Hunter. It's a great question. Certainly, oncology continues to be the most well-capitalized space in the life sciences. But within biotech, there are multiple hot emerging modalities right now. Those do include both gene and cell therapy. One other emerging area right now is RNA therapeutics. In 2018, Alnylam had Onpattro approved, and since then, other companies like Moderna have really been brought into the spotlight given their role in developing a COVID vaccine. There are other spaces within the broader realm of RNA therapeutics like RNA epigenetics, RNA degradation, RNA editing that are all exciting. So companies like Accent, Skyhawk, Arrakis, and Ribometrics have all had corporate partnerships in the past 12 to 18 months, and this is likely to continue. So this is definitely a space to watch. Additionally, both medtech and tools and diagnostics outperformed in the public markets last year. Overall, life sciences have been performing well. So hopefully this helps answer your question. And with that, I'll turn it back to Jay and Hunter.
Awesome. Thanks, Ben. Based on the folks on this call here live on the panel, I don't know if any of us are going to want to chime in on life science trends. So I think we'll just move on to the next question before we start talking about gene editing with this crew. Question number 2 is, what programs do you expect to be available in 2021 other than venture capital for funding a business? Grants, state grant matching, private company loans, SBA loans, lines of credit, any other options out there, etc. So for that, we went to the SBTDC and Mike Carnes for an answer.
Well, this is a great question because most companies won't go on to raise equity capital from venture capitalists and angel investors. And this doesn't mean you're not a great company. It just means you may not fit with investor expectations for what they need to get their ROI. If you're a newer company that's developing technology, you may take a look at the SBIR and STTR programs. These are federal grants of over $1 million to help advance your technology forward so that you can get that traction you need to raise follow-on capital. There are a number of great local programs like NC IDEA, local accelerators and incubators. If you're a company that's been around a little bit longer, you may take a look at some of the traditional lending programs like the SBA 7A loan, which provides working capital loans. You may take a look at SBA 504 loans. These provide capital for purchasing assets like equipment and buildings. And these same institutions can provide lines of credit to help with short-term needs. There are also a number of opportunities for international business expansion provided through the Ex-Im Bank and other lending institutions. And the SBTDC is in a great position to help you navigate all of these funding resources because we have counselors that focus on technology development as well as international business development and much more. be happy to talk to you about that, and also our role recently with COVID-19 and supporting companies with financing through the SBA programs. Thanks.
Awesome. Thanks to Mike for that. He mentioned a couple things, accelerator. Thad, we'll get to that after these videos. I know you have a perspective on that. And then finally, our third question from a caller, I guess not really a caller, more of an emailer, was interested in thoughts on justifying and supporting valuations for seed, pre-seed, pre-revenue type companies. So we'll go to Chris Dwight, who's an attorney with Pointer Spruill, for an explanation on that.
My name is Chris Dwight, and I'm an attorney in the business organization section of Pointer Spruill. And I'm excited to speak with you today, however briefly, about how to justify, or better yet, effectively justify, pre-revenue or very early stage revenue valuation. For the first-time founder to credibly justify a desired valuation while sitting across the table from an angel with a 30-year track record, it can come down to something as simple as this: having an answer, showing your work, and spending as little time on it as possible. You see, this interaction can measure the founder's investment in the essential blocking and tackling of raising capital. That is, the possession of deep, honest, and continually evaluated knowledge of concept, team, balance sheet, and market. And perhaps most importantly, the quality of your and your team's process in getting there. From there, you'll be better positioned to identify suitable valuation comps, to assign real value to your existing assets, and to more precisely estimate future spend and capital requirements. And for what it's worth, your attorneys will love it too. A self-aware client can make our jobs a whole lot easier.
Thanks, Chris. Follow up on that. If Thad or Tom can kind of remember back to when they did their first round, was there any sort of valuation back and forth? Was there anything you guys remember from those days on getting that first, what I assume was pre-money or early money valuation?
Yeah, I can go first if you want there. So, so for our first financing, I think you said you'll ask me this one later, so I'll skip over the details, but we did an accelerator. And so that one actually had a fixed structure where they take a certain percentage. So everyone got the exact same valuation. And so I think as you looked at our first financing post that, we raised about $300K. And so part of it was, all right, you kind of had a valuation set from the accelerator, so maybe it's bumped up from there. We weren't necessarily pre-revenue, but nothing exciting to promote the revenue we were at. So, it almost seemed to be a function of, we were first-time entrepreneurs. We weren't getting this credit of, these people know exactly what they're doing, so that risk was definitely priced in. And it was kind of more so, what's a fair percentage of this company to own? Ballpark, if they do okay or well, are we going to be able to hit some of our minimum returns? And so, I'd say it was kind of definitely more of the kind of art component kind of fell, in a midpoint of what's a good ownership percentage, what's a little more than the accelerator valuation, and can we at least get a decent return if this thing does just okay? So, but that's kind of how I think the discussion came together. And so there's definitely some back and forth too once we finalized, getting a little pushback and lowering the valuation. But
cool. Thanks, Tom. Any thoughts? Do you remember back in those days?
Thad touched on it. It's more art than science. Yeah. I mean, it's kind of, what do you think? Is it big enough opportunity? All the different things that are speculative, and a lot of investors at that stage would prefer to bet on people than to go to Vegas. But it's kind of very, very similar of, this is an art because we have no idea, so you got a spreadsheet, so you got a few transactions coming through, but so you have a this and that, but it's not, so it's very much art.
I hear, yeah, totally. It is. There's not a set formulation. You got to use multiple methods for valuation there. And to your point, it is an art. Real quick, we have about 5 or 6 minutes left. We're going to do a question or two, but before we do that, we want to release the results from our little survey we asked you all about 30 minutes ago. So here it is. What do you guys think? 2020 looks like most people think less dollars raised. Panel, you guys agree?
I, I don't know. I'm going to be the contrarian and say I don't think so. I think that there are a lot of dollars sitting on the sideline collecting 0% interest rates, and the market's at its peak. So where are you going to put your money? And I bet that there's going to be a fair amount of financing. Now, is it going to be really early stage risky stuff? I wouldn't bet on that, but good companies that have good opportunities that are most likely going to be targeted by all these publicly traded big old companies, there's going to be a lot of money, I suspect, moving into the market.
Yep. And I think there might be a little binary nature there too, in that I believe our old friend Epic Games had sort of announced that they were looking to potentially raise money again. So if they end up closing a deal this year, I can pretty much guarantee that we will be at a, at a larger number just based on that. But anyway, to move on, we do
$1 billion
have
here or there moves.
$1 billion here or there, whatever. So Thad, we've been kind of dancing around this one accelerator process. One of the questions from the emails was, what's the best way to approach the accelerator process, and how do you have an successful time in an accelerator?
Yeah, absolutely. So we actually, the quick funny story how we got into ours, and this may sound, now that I'm saying these things, sounds like a recurring theme. We didn't really know what we were doing, but there's a conference that Bull City Ventures puts on, and I believe it was at the time my co-founder and I were involved in the Collegiate Entrepreneurship Organization at State. I think Jason reached out and said, "Hey, if you guys want to have a couple students come by and volunteer to help, let us know." I think some people were hanging coats. I was writing names on stickers, and this person came up and just said, they said what they did, and I was like, "That's cool." And I was like, "Oh, my friend and I just started a company." And basically explained that, like, we're going to give you 20 grand free office and help you start it. And the percentage they named, I was like, that sounds like a steal. I was like, Kevin and I went back and we're like, these people are idiots. Like, what are they? Hey, we'll sign up for it. So we ended up actually, I think we only applied it to, it was only 2. So we applied to this one, and then there was a local one we had heard about. We applied as well. Once we this concept popped up, we did a little Googling, but I would say, one, the experience was good. It definitely, got us an environment with other folks building things. And so, I'm a big fan of it. And so, hindsight, everyone can look back and like, I wish I hadn't given up as much, but who knows where we'd be without that experience. And so, in terms of the process, there's a lot out there. There's definitely some different, I think there's a place called GAN or some of these other networks. I'm having trouble remembering all the names of them, but that you can go and find a list of hundreds of these things, and apply to them. And generally, I think, as Tom mentioned earlier, your ideas are typically pre-revenue early, so it's definitely investing in people. So I think, how can you really sell yourself to that process? And if I were to throw out some numbers, I think a lot of them are like, we're only going to see 10-20% of our deals be successful, but the economics can work out. And so, how do you really get them to believe that you're going to stick this out? You're not going to flame out or kind of give up at the first kind of bump in the road. And so, but yeah, they're definitely a good experience. And, you never know, even with that one or some other future financings, you never know you're going to bump into people, or, the amount of times you've had a good investor or a good business deal come out of me going, maybe I'll go to dinner with some people. I'm like, I don't really want to go. And I end up showing up, and, we meet someone who turns out to be a large customer of ours on the B2B side, or, you never know in life. So.
Awesome. Jay, I know you've partnered with Techstars in the past. Anything else to add on from your perspective on accelerators?
Yeah, I mean, there are lots and lots of accelerators out there. They all have, similar models and different models for the ones that actually provide funding and get some equity. The thing that's, I think, occurred more so now is they've started to get focused on specific verticals or specific industries. So here in Cary, Techstars and MetLife have partnered to run an insurance one. There are certainly ones for ag tech and med devices that are affiliated with hospitals or with teaching institutions. So what I like to tell the entrepreneurs is, do your homework, do your research. If you can find one that's focused on your industry, that's great. mostly because the other companies there are all going to be sort of facing the same challenges you have. The mentors, the experts are all going to have industry knowledge, and the investors who invest in companies in that space are going to follow the graduates in the cohort. So if you can find one that is vertical focused that meets your needs, I definitely encourage you to be considering that.
Awesome. Well, looks like we have run out of time. Always goes by fast. I'd like to thank our guests, Tom and Thad, and I'll even thank Jay for joining us today. But always great to talk to you all. Thank you so much. And, best of luck with the rest of the year, everybody.
Thanks, Hunter. Thanks, Jay.
Guys.
Take care, guys.
Appreciate it.